Welcome back, everyone, to another episode of Macro Matters, where we talk about the macro that matters for our CFA members and guests. I'm once again joined by Tony Zhang, my colleague at University of Illinois. Tony, welcome.
Hi, Rich. This year has been such a great year, and hope you have already had a great Christmas. And we are looking forward to see the new years in 2024.
Yeah, we are here on the last trading day of the year to talk about kind of recapping a little bit about what went on, but mostly kind of looking at how things are set up into the start of the year. 2023, as you said, very interesting year. I mean, actually one of the best years in history.
Yes,
Yet you wouldn't know that from talking to a lot of investors who seem to maybe missed out on it. You see, investment banks are generally letting people go now. What you normally see in a very strong bull market. But that's maybe has something to do with AI, and maybe that's why AI stocks are
I
driving the
think so.
market here.
I think so. Yes.
So I was, Tony, I had worked up on some slides that I had done for another presentation, and I thought it might be worth going through some of those today. So I think I'm
Sure.
going to start by sharing my screen and then we'll kind of go through some slides. And for those of you who are listening to podcasts, we'll talk you through what I'm talking about here. But for those who want to watch it on YouTube, you can do that. You can access that from our website to get to the YouTube. And so the first thing I wanted to talk about is, we started 2023 with consensus calling for, well, with not I would say consensus was calling for a recession in 2023, which never materialized, and that's because the yield curve had inverted. But if we this chart that I have here, Tony, shows you the yield curve inverting, but it also shows you the Bloomberg economics consensus that when what they think of a recession in the next 6 months, and that wasn't so high at the start of that year. So it wasn't really every economist pointing to a recession in 2023, though I think the loudest voices were certainly pointing to that. And as we know, the yield curve can be difficult, right? It has a perfect hit rate in terms of when it inverts, we have a recession. But the problem is we don't know when that's going to be. It could be in 3 months or it can be in 2 years. And so there's still some calls for a recession this year for a hard landing. I think the consensus, as we talked about last time, is that a soft landing is priced in. And
All right.
and ultimately, even though there's some, as we'll see later, whether or not we have this recession has a lot. Has a big impact on whether or not stock returns will be positive or negative this year. Because when we have soft landings, stock returns tend to be positive. When we have hard landings like recessions, stock returns, as we can see back through time, stocks always head lower. And so whether or not we have recession is still going to be a critical thing that we have to think about for early here in 2024. And this is another chart here. When I look at it, it has the ISM on there. It has leading economic indicators, and it has the relative performance of stocks versus bonds. And what you can see is that they all tend to move pretty coincidentally together. In the maybe sometimes the market leads, sometimes the ISM and leading economic indicators lead, but they're all fairly coincident because they all are leading indicators. And what's happened in the last 6 months, especially certainly in the last 2 months, is that stocks have massively outperformed bonds, even all of this year, by over 20%. And this isn't inconsistent with what we see with the ISM and the leading economic indicators, which are still suggesting that we should see lower stocks. And so that's something that is still kind of staying out to me. Is the stock market well ahead of where the economic data is, or is there still a disconnect here? One other thing I just kind of put on this slide, and I know it tends to be a super busy slide, is that I have GDP and unemployment rate on here as well. And what we can see with those two data points is that they are massively lagging data points. And I know
Correct.
that the market likes to talk about GDP and unemployment. And, first Friday of the month, we always get to talk about unemployment, but it really doesn't matter for the market performance. Maybe there's a lot of noise on that particular day, but we can see that it really is uncorrelated to market performance. And so I never really
Yeah.
understand why people focus on that so much. But maybe this is the one I want to talk about the most with you, Tony, because I think when we look at the bulls in the stock market, they say that, we're going to have a soft landing, and we have 6 rate cuts priced in for the Fed this year. And that's one of the reasons bulls thinks that stocks can still head higher, even though we are at very lofty valuations. However, if we look at rate cuts in the past, and I only picked one one period in the late 70s, early 80s. There's a number of different periods in there. But if we look at over the last 50 years, I have identified here five kind of broad regimes when the Fed cut rates. Okay.
Mhm.
And I've identified those with vertical lines, and I overlay the Fed rate cuts and the S&P performance. And what is very clear to me is that when the Fed is cutting rates right before a recession, which it has in 6 of the 8 times that I've identified, stock performance is always negative.
Yes.
However, in the 2 times, in the early 80s, 83-ish, and in the
Yeah.
mid 90s, 94, 95, when the Fed cut rates and there was no recession, stocks did well. So it really does kind of hinge on whether or not we're going to have a soft landing or a hard landing. And that to me is kind of the critical story as we kind of go into 2024. And what anything on those first few charts stand out to you, Tony?
Well, yes, I think Richard, this is a graph. It's a very nice indicator of the market that what had happened, especially in year 2022, last year, that both stock markets and bond market actually had negative returns simultaneously. So their correlation has been very, very high. This is which are actually rare that we saw. Typically, over the past 30 years, that stock and also the bond market tend to have a negative correlation. But over the past few years, because of the economic situation and also the extremely low rate environment, they move in the same direction. Last year, when we actually started to see the Federal Reserve took a very harsh stance over the rate policy, that both bonds and also stock market took the heat. But this year, now when we actually start to hear that Federal Reserve is softening their stance, they are actually willing to take the rate cuts, or even they set the signals that they're going to take this additional 3 rate cuts in next year, that both bonds markets and also the stock market rally significantly, even in the past few weeks. And Rich, if you recall that over the in our last podcast, when we actually discussed that there are actually a couple of divergence. One is stock market and also bond market divergence, large cap versus small cap divergence, value versus growth divergence. And we also mentioned that they will converge statistically. And that's what we actually see over the past 4 to 3 weeks, when small cap rally significantly, like what we could see or what we could refer to the stocks within the ARK funds rally like 40 or even 60% heavily just within such a short window. And also the crypto market also rallied huge just in over the past 1 or 2 weeks. That being said, we start to see the convergence. We start to see the relief of the divergence situation. But now going forward for the next year, especially from what we can tell here, now after years of that both stock market and bond market have a positive return, just as what we saw this year, historically, that might make investors to believe that the early 1980s situation might be the case for the next year. So this is what the stock market is thinking right now. At least I tend to agree based on most of the economic indicator and from the market sentiment. This has slightly larger chance that next year's both the equity market and also the bond market can still have some positive return. That's my thought.
Yeah, no, I think you're right. And I think if we're looking at those 2 periods when the Fed cut rates and the market rallied, the early 80s is definitely the analog that I think investors want to point to. Because I think to
Correct.
me, when I think of the early, like the 94, 95 period when the Fed was cutting rates, that was all about what was going on in the Asian financial crisis. Well, I guess it was more like 96. But they were cutting rates because of some problems that were going on abroad. And I mean, perhaps that's going to be the driver this year. But We were seeing money flowing into the US from overseas because of the problems overseas. And I'm not so sure that you're going to see that this time along. So I'm not so sure that that mid 90s analog is the right one here. But that early 80s, you're right. I mean, it can certainly be done. And so I think that's something that bulls are going to want to point to and want to kind of look for markers as to whether or not that we're continuing on that path. So a few other things that I want to kind of go through quickly is one here is I've created my own custom index called restrictive, and what this is it's this Fed it's the CPI minus the Fed funds rate, and when it's negative, that means the Fed funds is obviously higher than the CPI, which means the policy has gotten restrictive, and when it's positive, that means that the CPI is well below the Fed funds, or sorry, vice versa. So that when it's negative, that means that the policy has gotten restrictive. The Fed has gone too far in raising rates, and when it's positive, that means that the Fed hasn't gone far enough. And I've identified here a few circles as I look back over the last 30 years, and I compare the economy using GDP and the excuse me the annualized yearly S&P returns. And what you can see is that in all of these periods, when policy has gotten restrictive, as it is right now, we've gotten negative returns in the S&P. And that includes like 2017, 18, 19. That includes kind of 2014, 15. It includes that pre-financial crisis period, and it includes that mid 90s period that we talked about. Now, in the mid 90s was a very prolonged period, and so there's nothing to say that even though we've gotten restrictive in 2023, that anything has to happen imminently. It could last for quite some time, as we've seen before. But it does suggest that the Fed policy is restrictive, and maybe that is why the market's looking for rate cuts. And if those rate cuts don't come, as the Fed keeps kind of suggesting that maybe they won't come as fast as everyone thinks, or if inflation doesn't fall as quickly as people think, that it could pose some trouble for the markets in early 2024. To me, as I think about the economy and we think about soft landing versus hard landing, I'm always thinking about housing. Housing is the one thing, as we've talked about many times, leads the economy into and out of recession. It is the first mover. It's got a very large multiplier effect. And so I'm just looking at a few different things on this chart here. I look at the NAHB index, which is the National Association of Home Builders. And that's the line there in white. And that's the one that most people will point to. I have it inverted here to line up with the other reports. And it's weakened, or it was weakened in 2022. It was quite strong in early 2023, which was a precursor and led to really kind of the economy being better than we expected in 2023 and leading to higher markets. But in the last couple of months, even though we've seen stocks rally, the NAHB number has really kind of fallen off a cliff. And that's because mortgage rates until very recently have stayed stubbornly high. In fact, we'd hit levels close to 8% in a 30-year mortgage. Now, those have come back to just under 7%, but they are very, very high. And one of the big drivers of that I have in purple here is what I call the mortgage spread. And that's the spread between 30-year mortgage rates and 10-year treasuries. I call that the mortgage spread because banks that are making these mortgages are hedging themselves in 10-year US treasuries. And so they think about things on a spread basis. And when you look at it through time, that spread typically stays between 1.5% and 2%, pretty steadily, except for there are a few periods when we look at it, right around the financial crisis, right around COVID, and very recently when this spread has blown out to greater than 2.5%, or right now greater than 3%. And those periods are the periods when banks are very stressed and banks are unwilling or unable to make loans. The financial crisis is an obvious period. The spike during COVID is an obvious period. And right now, it could be twofold. It could be that the Fed, via its quantitative tightening, is selling mortgage-backed securities, causing some widening in spread. But it could also be that banks who saw a lot of deposits flee in March of this year still haven't seen any sort of recovery and therefore are unable to make loans. And so this is going to keep mortgages potentially stubbornly high. One thing that is kind of pointing that I think I've always found is a good indicator is it's not just mortgages that lead the housing market, but it's jobs. And if I look at just a simple index I created, which is a geometric index of mortgage rates and unemployment rate, it actually tracks pretty well versus that NAHB number. And it is actually pointing to a bit stronger housing market, as the mortgage rates have come lower and the job market still stays strong. And so it's not all gloom and doom in housing. I think the jury's still out a little bit, but this mortgage rate I think is going to stay stubbornly high for some, and so I think that's something to be wary of. And so that kind of, I think I've used this acronym on the Macro Matters before. I know I've used it in my LinkedIn before, but we talk about the HOPE acronym, which is housing, orders, profits, and employment, because that's how money flows through the economy, right?
Right.
When rates get to the level where housing can start to accelerate, what we see is new construction, building permits, et cetera, starting to pick up. Housing expectations start to pick up, and that leads to new orders for everything from lumber to copper to flooring to windows to landscaping to what furniture, everything. And so we start to see the ISM new orders data pick up. And ultimately, when companies start ordering stuff, they finally start to show some profits. And it's only after those profits come through do we finally start to see employment get better. The same thing works in reverse. When housing slows down, orders for everything starts to slow down, and companies' profitability starts to get hit. And then only when they start to lose profitability will they start to let people go. And so we've seen in 2022 we saw a much weaker housing market. We saw new orders get hit. We started to see profits start to get hit and unemployment start to tick up. But what's happened is that that early 2023 pickup in housing has led to a reacceleration in employment and a reacceleration in profits as orders kind of picked up. Now, as housing has kind of rolled back over, will we start to see a little bit of what we saw in 2022, starting here in 2024? I don't know. What do you think about housing and what it might be telling us about a hard or soft landing, Tony?
Yeah, Rich, just you are 100% right over here. The housing apparently actually intertwined with other companies like a financial status and also with the job market. The job market has been extremely resilient, just as the U.S. economy as well over the past 1 year. This is why both stock market and also house market had been so stable, or actually they haven't really fall off, even though according to the theory they should have already fall from the off the cliff. But the reason they haven't really done so was because of the strong job market, and people can actually afford to pay off their mortgage, and also people can afford for the rent. That's why the price for the housing market is so strong. Now, over the past 2 months, that we start to see some kind of softening in the job market, and that's why we also see some kind of maybe the lowest of the existing home sales in the house market in October. The data for the November, I think, will be out some that we actually can monitor that. But I think that the housing data for October was one of the softest in the past 2 years. This is actually tied to the job market. Now, if actually Federal Reserve continue to hold the interest rate for higher for too long, so even taking into the first half of year 2024, that we might see more companies that actually would suffer, or have the high pressure for their operation cash flow, which will put pressures over the job market. Then it will actually pass over to housing market in a trend. This is something that I think the investors should actually put a closer eyes on Federal Reserve's policy right now. So that's the point.
Yeah, I think you're absolutely right. I think what's going to happen with Fed discussions, and we'll get some new dots as we kind of go through into March because we'll have some new voters, et cetera. And right now, some of the dots are pretty dovish, and that has the
All right.
market getting pretty dovish, but that might change a little bit. And that's going to really be a critical thing to watch for housing. Housing stocks, if we look at the XHB ETF, that's a housing ETF versus spiders, you can see that it has a little bit of leading characteristics, and it had a very sharp move like everything else at the end of the year. That's giving people some positive vibes right now. We'll see if that kind of continues right now. This is one
I actually want to add one more comments
yeah.
which related to the housing market. Now, the housing market in the U.S. Can actually be divided into mainly two regions. One is apparently two coast area, East Coast and West Coast. The other is the Middle West. We actually have since the depressions of housing market in Midwest, we start to see the recovery of the housing market in coast area because of strong stock market performance. West Coast apparently rely heavily on the stock market performance due to the high tech companies. Like there are more IPOs and better like tech companies stock, then many of employee actually benefit from the higher stock options, so they can actually afford to actually pay for a new house. Now, on coast area, limited supplies was also one of the contributing issue for the stable housing market. But the housing market in the Midwest is the area that we saw more of the pressures at this moment.
Yeah, that's a great point. I think it's the housing market isn't national. There's definitely different demographic trends and definitely other drivers that are hitting the different regions, for sure. This is one I really wanted to kind of get your views on. So for those that are on the podcast, I'm looking at the on Bloomberg, they call it the relative rotation graph, RRG graph. It is what it looks to tries to show is that, and you can choose whatever assets you want on here. I have a number of different global sectors and asset classes and styles, et cetera. And I compare them to a cash benchmark. And what it shows as we kind of move around the graph clockwise is that there are some parts of the market that are leading, some that are weakening, and some that then fall into the lagging category, and then those that are improving. And I think to me, the weakening and the improving categories are the most interesting, because the weakening are those that had been the leaders that are starting to show some warning signs that we need to be wary of if we're along those areas. And the improving might be those that were underweight, or maybe if you're short or have no exposure, that have been lagging for quite some time and starting to get a little bit better. We clearly see the leaders of late have been crypto, as you kind of mentioned. Crypto has been very, very strong, as well as kind of tech stocks, et cetera. And the laggards have been more kind of in the commodity realm in Chinese equities. But interesting, like on the weakening side, we see the commodities are still on the kind of the weakening side. They had a really good run, but I've been left behind in this last 2 months of rally that we've seen. Everyone calls it the everything rally. And if you're a commodity investor, you're probably frustrated because it doesn't include commodities, I guess, because they have been left behind, and in some cases they've gone lower, as we'll see later. But I think the most interesting area to look at is the improving category, because this is populated with a number of things that people have scratched their heads of, why has this been left behind? And this includes things such as value ETFs. It includes dividend ETFs. It includes small caps, which have had, like you mentioned, a massive rise in the last 2 months. And it includes things like short interest weighted ETFs. And so it's really the laggards have really kind of caught up in the last 6 weeks or so. And that is, added to not only the magnitude of the rally, but it's added to the breadth of the rally. And I think that's something that, as we look into 2024, if that is set to continue, that would be a very, very healthy sign for the markets to start to see this rally broaden out from 7 or 10 stocks that have been driving it to include everything. And that might get a little bit more people excited about the start of the year and equity rallies. So what are you, from your standpoint, Tony, what are you seeing in terms of this asset allocation, as I call it?
Yeah, Richard, this is very interesting point from this like a rotation RG graph, and I think since our podcast, since we you started to actually to talk with the relative graph strengths RG here, that many investors actually have started to actually use this as RG graph. This is a very good thing from our podcast. So if we actually have seen from this graph right now on the pretty much up right hand corner, we can see the leading category asset category. It's a Bitcoin. Now it pretty much is reaching to an extreme point where we from statistically that they should actually to converge. Now lots of investors, as what we discussed in our last podcast, will still believe that the Bitcoin ETF can become legally and become available for in January, just approved by SEC. So that actually propelled lots of investors, both institutionals and retail investors, become extremely positive or optimistic about the future of Bitcoin and other alternate coins, Ethereum. Solana, right, had been grow up like 60% or 70% within such a small amount of time, reaching to an extreme. Most of the times that if we statistically we saw something like this, it's going to pull back whenever the news comes out. That's why I uh, think that investors should be very careful about whether they should continue to raise their allocation to the Bitcoins in year 2024, even after the Bitcoin ETF was approved. This is something that we hasn't really been sure yet, but a lot of investor has speculated because of the tickets for Bitcoin ETF. I think for two of the mainly funds have been listed over there. That's why they think that it must be approved. This, what if not that, or what we can see that a lot of the huge price pullback from the crypto market. Now, if we look at from the left-hand side, what we typically call it laggards. These are very sometimes it could be look very stressful, but from the investor point of view, if anything that improving, that could potentially be the alpha generator looking forward. Dividend and most of the values like ETF value asset classes have been extremely lagging pretty much most of the time in this year until from the beginning of December, including the dividend stock, value stock, small cap stock, and TLT. TLT, the bond market, has a very nice rebounds. We call it rebounds over the past 1 month or 3 weeks. Looking forward, going forward, if the trend of the conversion will continue, so in year 2024, if Federal Reserve does cut the rate as they indicated, we might start to continue to see the small cap might outperform the large cap without under the context of the soft landing scenario. And bond should continue to benefit from the lower rate, lower federal fund rates going forward. Now, bond that being said, investors should also take in the bond TLT as 10 years here. Should also take in this kind of allocation to the bond very serious because it still offers some kind of a buffer if the economy actually does go wrong or stock market does have some kind of issue crash in year 2024, the bond market will actually come and help in to provide some kind of a safety buffer. Now, dividend and apparently other value stock sometimes they tend to outperform when the Federal Reserve lower the interest rate, especially when the dividend yield is higher than the Fed risk-free rate. That might be the moment that the dividend stock can outperform growth stock again. This is something that what we have seen in year 20 and year 2021. This is something that I think from the asset allocation point of view, either both portfolio managers or other asset allocator can really think through and really think about the going forward. I think this rotation graph really tell us what have been moving underneath the market over the past couple of weeks. And this can actually help us to look forward in the future. The commodity apparently have become much weaker just because multiple reasons, strong dollar and strong economic demand under the high interest rate environment. One thing that I really wanted to point out, now the small cap performance over the past few weeks mainly come from, I think, the sentimental shipment over the federal's fund rate policy, not from the fundamentals. Fundamentals are still very poor, just as what we have seen from the small cap healthcare or biotech company. Fundamentals are, we haven't really seen any realistic or material fundamental change improvement in the healthcare, but because of this shifting sentiments over the future, federal run rate future, people might think that the worst for the healthcare stock or other small cap stock has already passed. The good things are, or hope is ahead of us, right? Hope is ahead of us. What if it cannot be materialized or realized that we will see a huge reverse of all of the performance suddenly? So this we have to for rational investors, should be keeping in mind. The fundamental we still remain terrible, but the recent performance, the rebounds have been just purely because of the sentiment factors right here, right now.
Yeah, I would agree. I don't have it. I don't have the chart here, but there's I think I've shown it before on Macro Matters. There's an index that I track I call the zombie index, which really what it looks at is it looks at companies whose interest expense is greater than their trailing EBIT for the last 12 months. And these are companies that are not earning enough to even pay their interest expenses. And clearly, I call them zombies because they're the Walking Dead. They shouldn't really be around. And those companies really, for the first 9 months of this year, had really struggled in performance with tighter financial conditions and with the Fed tightening policy, as they should, right? Because those are the companies that are most at risk. If I look over the last 2 months, those are the best performing companies in the Russell 2000, and now the performance has been so strong in the last 2 months that index has now outperformed the Russell 2000 and is getting close to what the S&P 500 is for the year. And to your point, Tony, those are companies that don't have strong fundamentals that are really just recovering because of maybe short covering, but also really based on this expectation of Fed cuts. And if that doesn't come, those particular names, which is about 15% of the Russell 2000 index, so it's a big chunk of it, are really at risk. And
Yeah,
one other
they're
thing,
actually racing with the Fed Reserve right now. If actually Fed doesn't actually cut the rates as faster, then the company can run up the cash flow easily, easily. So we might see more bankruptcy for the biotech and small cap in year 2024. Just really depends on when and how fast the Federal Reserve is going to cut the rate. I maybe want to add one more thing that
sure.
I think that we should mention. We actually did mention this at the beginning of this year, 2023, that we actually highlighted that investors to think about the emerging market, especially the Indian stock market, right, Rich?
Yep.
So we
Yep.
talk about that. Now, Indian stock market has reached to all-time high just in last week. So which actually, if the deglobalization process would continue, the India will still become a country that will benefit from this process. And it's still right at very, very early stage. If we just compare the India with like China in 1990, very early stage, 1990. So there are still room for Indian market to go. So here is one point that I would think that the asset allocator with exposure to emerging market should really think this is like incorporating some of this kind of a strong market, especially from the Indian stock market, into their investment universe.
Yeah, and that's a great point, Tony. And India has when we talked about it, wasn't just a near-term cyclical thing. It was really there's a long-term secular drivers for that story, and I
Correct.
think that is something that people will want to consider, especially when we see here in the lagging. We still see that the Chinese stocks are still in the lagging category. So within the emerging markets benchmark, an overweight of China of India, I should say, overweight of India versus an underweight of China still might make some sense as people look at that. But buried within this kind of graph, if you will, in another part of the improving category, I just want to highlight are the different buy right ETFs that we have. And there's a number of different buy right ETFs that have seen huge inflows this year. And that these are primarily for people who are looking for yield in addition to a little bit of beta. And I bring that up that they're definitely in the improving category. Investors have already shown a strong interest for them in this year. And those tend to lag pretty badly in very strong bull markets, but do very well in other types of markets, including in bear markets. And I wanted to bring that up simply because we're going to be having a CFA panel discussion on that at the end of February 21st, where we will be talking about buy right ETFs and other developments in the options market. So that's something that our listeners should kind of keep their eyes out for. I want to get through a few other charts. Try to go through these quickly in the interest of time. But some things that are interesting to me, that Jeffrey Gundlach and Bill Gross kind of turned me on to the idea that the ratio of copper to gold is a pretty good indicator for where 10-year Treasury yields are going to go, because it's basically a measure of what the global growth is looking at from the commodity market perspective. I've always looked at the dollar versus the Japanese yen, because that's the largest holder of U.S. Treasuries, and biggest pool of savings in the world, and both of these right now are pointing to lower U.S. Treasury yields, which is kind of consistent with what you're talking about, how the bond market has recovered quite a bit, and maybe there's scope for even lower yields. I mean, the bond market, 10-year Treasuries have come back from almost 5% to touch 5%, I think, and now it's well, it's around 3.8%. And so that's been a pretty massive rally in the bond market in a very short period of time. But maybe there's scope for even lower yields still. And just a couple short-term things I'll go through very quickly is put call ratios tend to be a pretty good short-term indicator. When the number of calls is moving higher relative to the number of puts, that's usually a very bullish sign. When the number of puts are moving higher relative to the number of calls, that tends to be a bearish sign. We've seen this ratio, of puts to calls falling, which has been a very bullish sign for the last 2 months. That's starting to flatten out. It hasn't quite turned up yet. If it started to turn up, I'd get pretty nervous in a very short-term standpoint. That's a yellow flag when I kind of look at that. So that's something people want to be worried about. And then another one I think is the AAII, which is the American Association of Individual Investors. I look at they give us the percentage of their investors that are bullish, the percent that are bearish, and the percent that are neutral. And what I found through time is that whenever the number of bulls minus the number of bears gets above 20%, and similarly, whenever the number of bears minus the number of bulls gets above 20%, that's indicated that we've kind of gotten to an extreme in terms of sentiment. And we saw in 2022 that bears outnumbered bulls by almost 40%. It was like the highest number we'd ever seen, and that we clearly was a sign that things had gotten too negative. But what we've seen right now, we saw it in the mid part of this year, that sentiment had gotten frothy, and we saw a pullback in end of Q3. And so now what we see is that number is again getting frothy and suggestive that maybe there's a near-term pullback, another yellow flag. So there's some yellow flags that we're seeing here as we kind of start the year, something to be wary of. But we talked about, Tony, that commodities are rolling over. Here's just a quick chart showing that commodities are breaking down, and the bears are definitely in control of the market there. I'm using the DBC ETF to look at that on the technical chart. And I look at this real quickly, and the weakness in commodities is being driven by energy. If we look at across all the commodity complex, and if we look at energy, it's not being driven by supply. It's not being driven by demand. Demand's been flat to moving higher globally throughout the course of 2023. The weakness in energy prices is being driven by the fact that global supply has now gone to all-time highs. And this is in light of the fact that OPEC Plus told you that they were going to be cutting supply, et cetera. But what we've seen before is that they tend to cheat. So the supply has actually gone up, even though they said they were going to be cutting supply. And so the weakness we're seeing in energy is not because of falling global demand. It's not because of any necessary recession indicators, if you will. It's because countries and companies are producing more oil than we've ever had before, and that's what we're seeing in weakness in oil. And I think that's something to be wary of. And if I could show you the next shot real quickly, is that the commodity index, which is the CRB, which is driven a lot by oil, has been falling, and that's been dragging down the CPI. And yeah, we can point to M2 falling, and maybe one of the reasons CPI is falling. But really, if we look at it through time, the CRB index is a bigger driver of what's going on in commodities. And I know for the core, we take out the food and energy, but ultimately what we find is that those energy costs percolate through even into the core. And so they end up being a big driver. And so does this mean if we're going to continue to see higher supply in energy and continue to see energy weigh on commodities, are we going to continue to see lower inflation? And is that going to help us with a soft landing? Any quick thoughts on that, Tony?
Well, yeah, Richard, apparently the energy price going lower would help the Federal Reserve to basically to be more willingness to actually cut the interest rate. High interest price due to the I think geopolitical tension between the Russia and Ukraine has caused one of the inflation drier over the past 2 years. Now, with I think that geopolitical tension between Ukraine and Russia actually have become relatively stabilized over there. I would just say I would use it temporarily, and with actually lower maybe potential demand from the expectation of the recession. Also, couple with what you just is saying that maybe the lie from the OPEC that actually put the energy price right now is getting lower. The lower energy price apparently will be very good for consumer and will be very good for this equity market and bond market, certainly for sure. This will be very good things. One of the good things that we can hope for almost every market at this moment.
Yeah, for sure. And I kind of point out here that, as CPI falls, we should expect to see it's another potential driver for lower 10-year treasury yields. And we know 10-year treasury yields is the anchor rate for everything that, for every asset class that we
All
price.
right.
Well, I will say though, if we look at that TLT, which is I think what a lot of people use as their way to invest in the bond market, we can see that at least on the weekly basis, it's running into some resistance here. So even though there's some drivers to maybe higher bond prices, much like a lot of others, it's kind of had a very big move and it's running into resistance. And so you might want to be careful in the near term, even though there might be some strong longer term drivers to that. And this is one thing I wanted to point out to you, Tony, and really touch on this is I plot here the Bloomberg Financial Conditions Index versus the relative performance of IWM to spiders. And so the relative performance of small caps to large caps. And this is a little bit of what we talked about before, is that as financial conditions get easier, small caps tend to outperform. We can look at that through all of 2020 and into 2020, early 2021. But then as financial conditions and the market anticipates that they're going to be getting more difficult, small caps will lag. And that's what we've really seen from middle part of 2021 all the way through until really kind of the first half of this year. And now we're finally starting to see small caps catch up a little bit. There's still a lot more room that potentially they could go in order to catch up with how much financial conditions have eased. But that's something that we were talking about before, is that the drivers of this move in small caps are these easier financial conditions, which make it easier for these companies that may not have the strongest fundamentals to still do well. Excuse me. But maybe we'll end on this one, Tony.
Yes.
With the lower U.S. Treasury rates and potentially see a weaker dollar, maybe it's time for investors to start thinking about global stocks outperforming the S&P. And this is what I've kind of have on this chart is a 20-year picture of the DXY index, and I plot that versus the relative performance of spiders to EFA, which is the MSCI Europe, Asian, Far East index. So it's basically everything in the MSCI ACWI index X the US. And so I plot the US versus everything X the US on the developed markets. What we see is that when the dollar is weakening, spiders tend to lag the global developed market stocks. And when the dollar is strengthening, spider outperforms those stocks. And so to me, it's always the dollar for me is a sign of it's a derivative, if you will, because it's people aren't deciding to make a trade in the dollar first and then deciding what to do in stock second. They're doing is they're showing a preference for U.S. stocks versus European stocks, and that kind of shows up in the strength or weakness of the dollar. As we're starting to see perhaps some signs that global stocks might be doing better than U.S. stocks, will we start to see investors moving into those global stocks, and will we continue to see that weaken the dollar? And will we finally start to see, these global international stocks, not just emerging markets, but global developed market stocks, start to outperform the S&P, because it's been really a 15-year run whereas the US has largely outperformed Europe for the better part of 15 years. Is that something where we might be starting to see a change in trend, Tony? Any thoughts on that?
Well, Rich, this is a very nice graph, in my opinion, because um, traditionally, like for people in this country, in the US, so also for the people outside the US, they tend to think about the US is a country of only importing. So consumer here or residents just rely on the goods that importing from external from other countries from globally. Now they actually is just part of the story. They are partially right. Indeed, U.S. is a country of exporting. This is maybe contrary to many people's belief. So what actually does U.S. export? The U.S. dollar. So the U.S. dollar has become a good step for the U.S. for a country for that we export outside globally. With the weaker dollar, then we actually tend, you can think about it as a goods. When the price of the dollar index is getting weaker, then there will be coming more demands globally because we can, from economic a point of view, that US dollar will actually go out of this country to actually to buy more goods globally. That would help to improve or enhance the liquidity of emerging market or other developed country. That will be the time that the emerging market will tend to outperform the U.S. Market. Now, getting with the U.S. Dollar index is written to close to 100. Typically, 100 is the threshold. Whenever it actually dips below the 100, that it actually indicate a weaker dollar. When it stay above 100, it's like a strong dollar. Now it's very close to 100. If it actually does dip below the 100, then we should expect that we more of the U.S. dollar flowing out from the U.S. to other emerging market. That might be the moment that we should really think about uh, allocating more to emerging market than the developed market in the U.S. Rich.
Yeah, very good. And so just a few last charts here that we'll go through. I'm like, we talked about the IWM a few times, and this is just a technical chart that it's clearly broken out in the short term, but it's looking overbought as we kind of indicated. The longer term trend is starting to look pretty positive though, so there might be time for good stock selection there. Global stocks definitely look like they're breaking out here, so that's something to consider along the lines of what you're talking about. And I think there's a few different signs that suggest that maybe this is a good time to consider international stocks in one's portfolio. And then U.S. stocks are looking overbought at the same time that they're hitting all-time high levels here, which is another potential yellow flag. And so I think, Tony, that we'll kind of maybe leave it there, that there's maybe some short-term yellow flags here, maybe some short-term concerns about what could happen in the U.S. economy, maybe some overbought U.S. stocks. But there's a number of things to be positive about, and as we look into 2024 as well. So I think hopefully what we kind of laid out here for a lot of our listeners is some questions that they need to be thinking about and trying to answer as they look about and think about their portfolios going into 2024, into the first quarter, et cetera. Any last thoughts, Tony?
Yeah, January is the most important or critical month in a year. And as what we have seen that the January this year, 2023, the stock market has a positive return that pretty much the whole year has a positive return. That's what we typically call the January effect. So now in year that the coming January 2024 will serve also another great indicator for the stock performance in year 2024, with many the U.S. stock market actually reaching to overbought, and also IWM, they all reach to the overbought area. Now I'm very anxious to see how the stock market will perform in January. That will actually provide us a lot of thoughts on what investors, how the stock market would go going forward in year 2024. In short, the bond market will still look very attractive, and it should actually serve as the safety buffer for investors. So it should be at least serve as one of the major components within investors' asset allocation going into year 2024. But as Rich, at what we have been discussing here, we are partially optimistic about year 24, but we still hasn't ruled out the chance that recession can happen.
Yeah, you're absolutely right. And if a recession does happen, then it's tough to be optimistic about stock markets, especially given the leveling and given the history. And if that's why the Fed's cutting rates, is that because we're having a recession, it would be difficult to be positive. So we're really rooting for a soft landing as we go into 2024. There's some signs that we could get that, and that's kind of what the market is pricing and what the market needs to see. But that's why, and that to me, that's another reason to maybe potentially diversify into other markets, maybe outside the U.S. is to kind of take that to take some of that risk out of one's portfolio. Anyway, just for the listeners, I know we've had a little bit of an erratic schedule here of late, but we're going to be back onto a regular schedule where we'll be recording these every other Monday as we kind of go into 2024. And so look for those to be coming out on Tuesdays or Wednesdays every other week, so we can get on a little bit more regular schedule. And then follow up on some of these important points as we kind of get the data that comes out. We'll have some next time we talk, Tony. We'll be seeing some early economic data in January, and the time after that, we'll starting to see some earnings. And so, well, we'll get a lot of information in the month of January that's going to really set the table for the first quarter of 2024, and oftentimes for the rest of 2024 as well.
Yes, I would also like to take this opportunity to say Happy New Year to you, Rich, and also other CFA staff, and also Happy New Year to all of our audience of Macro Matters.
Yeah, that's a great point. Happy New Year to you as well. Hopefully everyone has a happy and prosperous New Year. That's what we're rooting for everyone. Thanks for listening to Macro Matters.
Yeah, thank you.